This is Efrem Hoffman broadcasting live from NakedSwanTrading.com for Monday, June 25th, 2012 at 10:55 p.m. Today's focus is going to be on the S&P 500 Consumer Discretionary Index. And the reason why we're focusing on this index is because we believe that this represents a pretty good indicator of consumer confidence on a go-forward basis. And based on our previous discussion last Monday, we talked about how the S&P was likely to roll over in the 1350 to 1360, 375 area, and that's exactly what happened to the market in the past week. But that's the short term. I really want to talk about, what part of the S&P could really impact the economy, and if there's any indicators right now in the market that's telling us that the economy is weakening. And there certainly is. The XLY, which is an exchange-traded fund that tracks the Consumer Discretionary Index, is basically telling us that there is some serious trouble. Just to give you an idea of some names that are in the Consumer Discretionary Index, it's made up of McDonald's, Comcast, Walt Disney, Home Depot, Amazon, Ford Motor, News Corporation, Starbucks, Nike, Target. Okay, those are just a few that are in there. Okay, those are just some of the top 10. But what I'd like you to realize, well, first, I'd like to make sure that all of you are aware that just because I'm indicating that there is major headwinds in the S&P Consumer Discretionary Index does not necessarily mean that each and every one of those equities in there are automatic shorts, okay? But it does mean that we should be very cautious on the economy going in to later in the year and going into next year, because usually the stock market forecasts economic conditions as early as 3 but usually 6 to 9 months out, and that would take us into early next year. And with the expected extreme capitulation in the market going into May of next year, we could see a very strong deterioration throughout the year in the consumer front, okay? And the specific levels that the map is indicating right now, and this red area that's boxed in, basically carries us out into the later September period. It began just a few days ago as we issued that warning last week that the S&P was going to top. So the consumer discretionary is probably one of the weakest sectors going forward that is really going to roil the market, okay? It's the canary in the coal mine for what's going to happen in the economy, and it does not look good, okay? We've got a confluence of interference or resistance, overhead resistance extending way into the future, and this is a very dangerous zone where you see this blue or navy line upward sloping underneath this black line. This is a very intense area we need to be very cautious of, because any value in the market where it closes below 41.16, and especially trading below that level for 1 day or more, regardless of what the volume is, volume will come in after that. The market is at serious risk for having a gap down to 35.36. That may not seem like a lot if you're just trading, a $40 stock going down to $35. But when you're talking about an index, and that's only level 1, level 2 is 33.37. When you're talking about an index, that is a huge drop, especially when you consider the volatility and the nature of how the market rallied very strongly up to these highs, came down, and now it's kind of formed a 50% retracement back towards the high. It's now failing, and it's failing on this upper blue boundary and this red boundary. You're going to see in the future, every time it touches, if there happens to be any good news in some part of the market that carries it back up here, it's going to end up failing every time it hits there. And that level is between 43.85 and 44.67. And, you know, if a market can't bust up, it busts down and it builds cause to go down. And this red line that's sloped up is very, very bearish, especially if price gets underneath it while it's sloped up. So we really got to be cautious going into the period of July 4th to July 23rd, and perhaps as far out as July 26th to August 3rd. And then, of course, you could get retests going into the latter September period. And this is the phase, that would be phase 1, okay? And that would be a wave 3 down for people that follow Elliott wave theory, okay? You could see just recently when the market made a new high over here, a local high, it came up with about 10,536,000 shares, okay? The previous high bar that it took out had actually a fewer number of shares. Let me just see here exactly how many it had. Well, actually it had a little bit more. It had about 12 million. Okay, so we had less volume going into the high, which is negative. That's why the market kind of gave it up. But it also was in confluence with our resistance, overhead resistance area. So this is a very bearish development in the market. Now, in the most bullish setting, if for some reason they could, the government could hold this market up and manipulate it, at the very best, this purple boundary that you see slope down, eventually it's going to start sloping up somewhere into the fall, okay? So at the very best, you're going to be contained at the upper end of this area and just consolidate like a yo-yo between these areas. And then once you break out of this box, you're going to get some kind of major volatility event. So from a trading point of view, technically there's an asymmetric trade developing because there's more risk to the downside than there is gain to the upside. So, you know, option strategies that take advantage of volatility, you know, looking out, you know, with expiration periods, I like going out at least 6 to 12 months with an 80 delta, basically meaning that every dollar or point the stock moves, the value of the option moves 80% of that value. Less time erosion when you get 80 deltas. Yes, it's true that you'll have less leverage, but then of course the goal is to actually make money, not try to raise the risk level through leverage and then lower your probability of winning during that point. So the key is to know the time period where that risk could take place, okay, and then protect yourself. That could be done either in the option market or it could be done by just not holding a position in the equity market and then waiting for a better valuation to come your way, you know, sometime next year. But and also, you know, there are a number of people that just like, you know, going short exchange traded funds, and sophisticated investors can do that at key levels. But I do stress that whatever I'm saying today is not a recommendation. These are trading ideas, okay? And these ideas are for research purposes only. So you could take this, you know, to your advisor, or if you're a professional trader, you know, use this as part of your tool set, but don't make a sole decision based on this information. This is more of a research intelligence method that's saying what this method sees based on current and forward-looking market action. Okay. So this pretty much summarizes the weekly update at nakedswantrading.com. I'd like to encourage all of you to revisit our site and sign up for free weekly webinars if you haven't already. As well, I also encourage you to come by our site at some point, either later this week or next week, when we're expecting to launch our first product that will take you deep inside high probability trading securities, whether it's futures or exchange traded funds that comprise the S&P, or individual stocks, or whether it just happens to be a high probability event in the S&P market on a weekly basis or daily basis. That is going to be available for purchase, so that you could get a better handle of what's happening in the market on either a daily or weekly basis. Okay, but in the meantime, these updates where we key in on one or two ideas a week are going to be available